Hello everybody, my name is McDonald. I'm Director of Financial Crime Market Engagement at Experian. UK businesses are a popular choice for financial criminals. But why is that? Well, there's three key reasons. And the first reason is credibility. Now, the UK is considered to be a low-risk country, a low-risk jurisdiction. And you can obtain that credibility by setting up a company at Companies House. Now, Companies House, they gather and process vast amounts of information, but they do not verify the legitimacy of it. You can really enter in anything. The data can be easily manipulated. The second reason is anonymity. So Transparency International recently published that over 50% of Scottish limited partnerships have their ownership obfuscated through Belize, Dominica and the Seychelles. Now in 2016, in the UK, the Persons of Significant Control Register was set up, and that was intended to improve the transparency and understanding of who owns and controls organisations. But again, unfortunately, that information entered into the register wasn't verified, and therefore was open to manipulation. So the final reason is the ease at which you can set up a company at Companies House. It only costs £12. It takes no more than 10 minutes. And if you compare that to our European counterparts who are charging around about €300, that's £265. That cost point doesn't really act as a deterrent for either financial criminals or indeed pranksters who want to demonstrate the ease at which the register can be manipulated. At Experian, we've been looking at the levels to which the UK has been compromised. And if we look at just the last 3 years, we've seen a 116% increase in UK firms that are associated to EU-defined high-risk third countries. Now, these are the countries that we know are the most susceptible to being used and abused for financial crime. In the last decade, we've seen a doubling from 35,000 to 70,000 of businesses in the UK that have been set up where they've got no UK-based directors whatsoever. One other concern that we have in the UK is stolen addresses. So before 2016, there would be nothing that you or I could do if somebody stole our residential addresses to set up a business. But in 2016, the Company's Address of Registered Office regulations came into play. And that meant for the first time, if somebody did steal your residential address, then you could contest it. You can let Companies House know. And Companies House would default your address to their registered office based in Cardiff. Now, Experian have been monitoring this since 2016. If you have a look at 2016, there were around about 7,500 of these suspicious addresses. But here we are today and we're far in excess of 25,000 of these. Now, we know that 3,000 of these resulted in an RPO6, and that's where individuals have taken action to forcibly remove their addresses from the register. The reality, however, is that many of these go unreported. Many people will get this letter through the post and just think it's an error and they pop it in the bin. So at Experian, we've been trying to understand how many suspicious residential addresses exist in the UK. To define suspicious, we're looking at where a residential address has more than 100 businesses registered. And again, if you have a look at the stats, we can see that from the last 2 decades, that's increased from, again, about 7,500 to more than 20,000 residential addresses, where each one of these, there are more than 100 businesses. Now, we've purposely excluded formation agents, lawyers and solicitants to eradicate any possibility of introducing false positives. So now one final issue that we have is where the criminals are stealing the credentials of dead people. We call these zombie directors. There are more than 6,400 businesses today that have zombie directors, and this is where the directors are already dead at the point of incorporation. Now, listening to these stats, I can absolutely understand why you might be filled with a certain level of trepidation if using Companies House as your primary or sole means of verifying that a company exists, you understand what they're doing, and you understand the people behind that business. But in the UK, we're in a very fortunate position because there's so much other data that's available. So beyond Companies House, in the UK, we've got the Financial Conduct Authority, we've got the Charities Commission, we've got the Gambling Commission, we've got the VAT Register. We're also gifted in the UK with an abundance of open government licensed data. So if your customer happens to be a pub, consider looking at licensed premises. If they're a restaurant, consider using Food Standards Agency. If they're a care home or a dentist, Care Quality Commission. A school, maybe use Edubase, and so on and so on. Now, what I'm not suggesting is that there's a best version or source of truth for your given customer depending on their profile. What I am saying is multi-sourced data corroboration is going to be key. So if your customer is presenting themselves consistently to not only you, but across 5 third-party data sources, that should give you confidence. However, conversely, if they're presenting themselves inconsistently to you and across those 5 data sources, that should give you concern, or indeed, if they're not on data sources that they should be, that absolutely is a red flag. If you use these data sources, you can expect 2 key benefits. The first one is that you will understand risk irrespective of the composition of your customer base. So rather than having companies' house data that's very much biased towards risks of businesses, you'll be able to have data that can afford you information on non-limited, charities, sole traders. In addition to that, it will help you to better identify exactly where does risk exist, and if you can more accurately identify where risk does exist, you can be more confident in the vast majority of your customers where risk does not exist. So for more on this, we're joined by Alan Brown from Aptitude. Alan, can you just quickly introduce yourself and tell us a little bit about Aptitude, please?
Hi Scott, so my name's Alan Brown. I'm the Chief Technology Officer of Aptitude Global. Aptitude are a data consultancy. We specialise in building efficient, effective solutions using data in financial services and other regulated industries.
So Alan, I've been talking a lot around the value of third-party data, and I know you've got first-hand experience of implementing third-party data in a Tier 1 bank. Can you just talk me through those experiences?
Yeah, sure. So third-party data really gives us the opportunity to create efficiencies in financial crime and fraud processes effectively. So in our experience, the significant costs of financial crime compliance are in people, data and technology. Now, by utilising data specifically, we believe that we can build efficient processes that reduce the need for as many people and as expensive technology to help fight financial crime.
And Alan, you've used it specifically in automating remediation effort. Can you just talk us through what that's done?
Yeah, so in terms of the remediation effort now, I guess you've got a large variety of different entity types, customer type, that we had to effectively remediate for a large Tier 1 bank. Now, what we sought to do and what we did was utilise third-party data in order to create efficiencies in that process. And these efficiencies were primarily in 3 areas. So one, we wanted to reduce the number of cases, and we did that by automating the validation checks that you would conduct as part of that investigation. So by comparing internal data to third-party data. Point 2, when you had to conduct a file build, it's possible to reduce the amount of effort, so reduce the average handling time, the case build time, by automating some of the checks that a KYC analyst would normally perform. So by introducing third-party data, you can pre-populate information within the KYC due diligence file build and ultimately reduce the handling time of that case. The third key area for us in terms of building an efficient solution was trying to reduce the volume of outreach. So outreach is one of the more expensive processes, part of customer due diligence. And by reducing the number of times that you have to email, telephone call a customer to provide information, that reduces the overall cost and complexity of the case. And we can utilise third-party data to validate and verify some of the information that we would normally have to verify directly with the customer.
So you mentioned, Alan, about reducing outreach and automation and actually different portfolio types. Can you give us a view on actually the levels of automation that's achievable across those different portfolio types?
Yeah, so certainly, through our experience, we were able to automate about 85% of remediation checks for consumer records, for consumer customers. For sole traders, we were able to achieve 45%, and for limited companies, which had more complex, questions that we had to answer around the structure and makeup of the company, we were still able to achieve about 30% automation in that respect. So again, a significant reduction in the overall cost.
And how does that translate into revenue figures, Alan?
Banks are spending, even in BAU, tens or hundreds of millions of pounds per year. That can be even more in terms of the remediation costs when you're trying to remediate large back books of customers. What we're able to show through our experience with a Tier 1 bank is that operational savings, or cost avoidance of operational savings for remediation, we were able to see savings of between 30 and 95 million pounds.
And can you just touch on, finally, Alan, how that data can support a transition to event-driven reviews?
Yeah, absolutely. By utilising third-party data and continuously monitoring multiple sources of third-party data, what you're able to do is be able to monitor for changes in that information and feed that together with your internal data into your customer risk assessment process. By doing that, you can monitor for changes in customer risk and then flag those for review with your KYC analyst. Now, that allows you to transition away from a more expensive, more intrusive periodic review process with your customers.